Here's something that's going to sting a little. You have probably watched a stock, or an opportunity, or a moment move. Maybe it doubled. Maybe it ran 40% in 3 weeks, and you watched the whole thing happen without you. And the worst part? You saw it coming. You were watching it. You even thought about getting in. But you waited. You second-guessed yourself. You told yourself you'd wait for a little more confirmation, a little more certainty, just one more signal. And then it ran. Without you. Write in the comments where you're watching from and what time it is. I genuinely want to know who's on the other side of the screen. And if this video hits different for you, subscribing and liking costs you nothing, and it helps more people find this content. Okay, let's get into it. Now here's the question nobody asks out loud. What if the problem wasn't that you were too slow? What if the real problem is that you've been trained by the noise, by the headlines, by the culture of financial media to always arrive exactly one step too late? Because the market doesn't reward the loudest voice in the room. It doesn't reward the most active trader or the guy refreshing his portfolio 17 times a day. It rewards the person who learned to be quiet, the person who learned to wait, the person who understood that most of what looks like opportunity is actually a trap, and that the real move always comes after everyone else has given up. That's what this video is about. Not tips, not hot stocks, not a system you can buy for 3 easy payments. This is about the one thing that separates people who actually build wealth from people who stay broke while feeling busy, and it has almost nothing to do with intelligence. Before we go any further, if you're new here, hit subscribe. I make these videos for people who are tired of being talked down to about money. No fluff, no hype, just the stuff that actually matters. Now let's keep going. Most people think the reason they lose money in the market, or fall behind financially in general, is because they don't have enough information. They think the winners have some secret edge, some insider knowledge, some algorithm or tool or premium newsletter that tells them exactly when to get in and when to get out. So what do? They consume more YouTube, more podcasts, more stock screeners, more financial Twitter. They think if they just absorb enough, they'll eventually crack the code. But here's what nobody wants to say to your face. Information is not your problem. It never was. Think about how many people knew intellectually that buying index funds consistently over time is one of the most reliable wealth-building strategies ever documented. They knew it. They could explain it to you at a dinner party. And they still panic sold in March of 2020 when the market dropped 30%. They still yanked their money out at exactly the wrong moment, right before the fastest recovery in market history. The problem isn't knowledge. The problem is psychology. The problem is that we are wired deeply and almost unshakably to do the wrong thing at the wrong time, and the financial system is specifically designed to exploit that. Here's the thing that took me a long time to really absorb. The market is not a neutral place. It is not a fair machine that simply prices things accurately. It is a crowd, and crowds behave in patterns. Crowds get excited together, crowds panic together, and crowds, almost without exception, arrive late. The average retail investor, the regular person sitting at their kitchen table, watching CNBC, reading Reddit threads, checking their brokerage app, is by definition part of that crowd. And the crowd is always the last to know. Not because they're dumb, but because the entire information structure they rely on is downstream of where the real action already happened. By the time something is on the news, it's already priced in. By the time your coworker mentions it at lunch, the smart money already took profits. By the time it feels safe to buy, you're not buying early, you're buying expensive. And that's not a character flaw. That's just not understanding how the game actually works. Let me paint you a picture that I think is going to feel uncomfortably familiar. A stock, let's keep it abstract, this applies to literally any asset, has been sitting quiet for weeks. Nothing exciting. It drifts up a little, drifts down a little, goes basically nowhere. The people who bought it a while back are getting bored. They're watching other things move. They start to wonder if they made a mistake. And so, slowly, they start selling. Not in panic, just in boredom and quiet frustration. And here's what most people miss. While those bored holders are selling, someone else is buying.
Not loudly, not in a way that shows up on any headline. Quietly, patiently, in small enough pieces that it doesn't disturb the price too much. They're accumulating. They're absorbing every share that the impatient people are letting go. You can see the evidence if you know where to look. The stock dips, but it doesn't dip as far as the last time. It sags, but it snaps back faster than it used to. Every low is a little higher than the last low. It's like a staircase being built, one step at a time, underneath the noise. Most people never see this because they're only watching the highs. They're waiting for the stock to scream, to announce itself, to make it onto a hot list somewhere. But the real story was always being written in the lows. And then one day, after weeks or months of this quiet accumulation, something shifts. The supply runs dry. The patient sellers are gone. The board holders have left. All that remains is a stock being held by people who aren't scared, sitting under the ownership of hands that are not weak. And when even a small wave of new demand hits that setup, the price doesn't just move, it launches. Now the crowd notices. Now it's on the screener. Now it shows up in the trending section. Now your coworker texts you about it. And the people who are just now piling in, they're not early. They're the fuel for the exit. They're buying from the people who were patient enough to buy 6 weeks ago when nobody cared. That's the cycle. It repeats constantly across stocks, across asset classes, across real estate markets, across almost every financial opportunity you can name. And the reason most people stay on the wrong side of it isn't intelligence, it's impatience. Here's the psychology piece that I think is the real gut punch. The market is extraordinarily good at manufacturing impatience. It shows you a little move, just enough to get your heart rate up, just enough to make you think this is it, this is the one. You buy in, feeling sharp, feeling early, and then the stock reverses. It drifts back down. Maybe it goes lower than when you bought it. You sit there watching the loss tick up, and eventually you sell, disgusted, telling yourself the market is rigged or random or unfair. But here's what just happened. You weren't shaken out by the market being random. You were shaken out by a mechanism that exists for the specific purpose of removing impatient people from positions before the real move starts. They call it a false breakout. I call it the patience tax. The market charges it to everyone who hasn't learned to wait, and it charges it repeatedly on the same people until they either learn the lesson or they quit entirely. The cruel irony is this: getting stopped out in a false move doesn't just take your money, it takes your confidence. So when the real move finally comes, the one you were actually positioned for, the one your original instinct was pointing at, you hesitate because you just got burned. And while you're sitting there licking your wounds and talking yourself out of it, the stock runs 30% without you. That is not bad luck. That is a pattern. A very specific, very predictable pattern that plays out on almost every time frame in almost every market at almost every level. The antidote isn't a better indicator. It isn't a tighter stop loss or a faster data feed. The antidote is developing the ability to tell the difference between noise and signal, between a feint and a real move, between the market testing you and the market rewarding you. And the way you develop that ability is not by trading more, it's by watching more, studying more, slowing down when everything in your body is screaming at you to hurry up. If this is landing for you, if you've seen yourself in any of this, do me a favor and subscribe. I make this kind of video regularly, and I don't want you to miss what's coming next. Now, let's keep going.
Here's the mindset shift that I think changes everything. Most people approach the market, and honestly, most of their financial decisions, as if the goal is to be active, to be doing something, to be optimizing constantly. We live in a culture that celebrates hustle, that treats busyness as a virtue, that equates movement with progress. But in investing and in a lot of financial decision-making, activity is often the enemy of outcome. The most dangerous thing you can do with a portfolio is touch it constantly. The most expensive habit a retail investor can have is the need to always be in something, always be doing something, always be reacting to something. Because the market knows this, it is, in a very real sense, built to exploit this. The volatility, the false signals, the breathless news cycle, the red and green tickers flashing all day, all of it is friction, and friction costs money. The people who quietly build wealth over time are not the most active traders. They're the most disciplined waiters. They're the people who look at a setup, recognize the signs of real strength building, and then have the remarkable, almost countercultural ability to just sit there and do nothing until the moment is right. That sounds simple. It is not easy, because doing nothing feels wrong in a world that rewards visible effort. Sitting on a position that isn't moving yet feels like a mistake when you could be chasing whatever is moving today. But here's what I want you to really sit with.
You don't need to be in 100 trades. You need to be in the right ones. And the right ones, the moves that actually change your financial picture, are almost never the ones that feel urgent. They're almost never the ones you chase. They are almost always the ones you waited for. Think about what this means for your actual life, not just your portfolio, your life. Because the patience and discipline we're talking about here isn't a trading skill. It's a life skill. It's the same muscle you use when you don't blow your tax refund because you can identify the difference between a want that feels urgent right now and a decision that actually serves you. It's the same muscle you use when you don't take on more debt to look more successful than you are. It's the same muscle you use when you stay in an investment during a scary dip because you understand the bigger picture. Money rewards people who can feel the urgency to act and choose not to, every single time.
So, what does this actually look like in practice? Not in theory, in real life for a real person who isn't a professional trader and doesn't have 8 hours a day to watch charts. The first thing is this: stop mistaking activity for progress. If you're checking your investments multiple times a day, you're not managing them better. You're just giving yourself more opportunities to make an emotional decision. Set a schedule, maybe once a week, maybe once a month, depending on your strategy, and stick to it. The noise between your check-ins is not information, it's interference. Second, learn to recognize the difference between a move that has conviction behind it and one that doesn't. In a stock, conviction looks like volume, like quick recoveries from dips, like a price that refuses to go back to where it came from after a breakout. In your own financial decisions, conviction looks like a plan that still makes sense when you remove the emotion from it. If you can only justify a decision when you're excited, it's probably not a conviction decision. It's a FOMO decision, and FOMO decisions are almost always expensive. Third, start paying attention to your own patterns of behavior. Most of us make the same financial mistakes on a cycle. We get optimistic at the top and fearful at the bottom, in markets, in our careers, in our spending. The awareness of that pattern is the beginning of breaking it. You don't need to be perfect. You just need to catch yourself 1 or 2 moments sooner than you used to. Fourth, respect the value of doing nothing. There will be weeks in the market and in your broader financial life where the right move is genuinely to sit still, to not react, to not buy, not sell, not refinance, not switch jobs for a slight pay bump, not upgrade your lifestyle just because you got a raise. The ability to hold your position, financially and psychologically, is worth more than any tactical move you can make when you're reacting to noise. And fifth, maybe the most practical thing I can offer: build a buffer. Not just an emergency fund, although yes, that too. Build an emotional buffer. Build enough financial slack in your life that one bad quarter doesn't force you to panic sell. Build enough stability that you can afford to be patient. Because the single biggest reason people make terrible financial decisions isn't ignorance, it's desperation. When you're financially stretched, you can't afford to wait. And when you can't afford to wait, you always lose.
I want to leave you with something that I think matters more than any tactic or strategy I could give you. The reason most people stay financially stuck is not because the system is too complicated. It's not because they weren't born with some special gift for numbers or investing. It's because they've been taught, by media, by culture, by the financial industry itself, to stay reactive, to always be chasing, to measure their financial intelligence by how much they know rather than by how well they wait. The quiet truth that changes everything is this: the market, and money in general, rewards the people who learn to be still, the people who watched long enough to know the difference between noise and signal, the people who had the discipline to let the crowd rush in and get burned on the false move, and then calmly stepped in for the real one. You don't need to be the smartest person in the room to build real wealth. You need to be the most patient one. And patience, unlike intelligence, is something you can actually develop. It's a practice. It gets stronger every time you choose to wait instead of react. Every time you look at the chaos and decide that it doesn't require your participation right now. You are not behind. You are not too late. You are not fundamentally broken because you've made reactive decisions in the past. The market has been testing you, and now you know what it's testing for. Progress beats perfection every single time. The goal is not to never make a bad trade or a bad financial decision. The goal is to make fewer of them and to make the right ones when they count. If this video gave you even one thing to chew on, I'd love it if you subscribed and left a like. It genuinely helps the channel grow and lets me keep making content like this. And drop a comment below. Has impatience ever cost you money? I want to hear the real stories. I'll see you in the next one.